Okay, still with the gross profit method, we're going to look at another exercise. As a matter of fact, you might even want to try this one just on some paper before watching the video. See how it goes for you. But it's very similar. Here, let's read it. Exercise 9.6 is on pages 509 and 510. On November 21st, 2016, a fire at Hodge Company's warehouse caused severe damage to its entire inventory of product text. Hodge estimates that all usable damaged goods can be sold for $12,000. So it wasn't a complete loss. Some of the damaged goods could be sold for $12,000. The following information was available from the records of Hodge's periodic inventory system. Again, this is crucial. They're using a periodic inventory system, so they're having to estimate the amount of the fire loss. They don't know it for sure. Like they'd have a much better idea of what it was if they were using a perpetual inventory system. But with a periodic inventory system, they give us, we know our beginning inventory on November 1st. Looks like this is just for a month. We know net purchases from November 1st through November 21st, the date of the fire. Net sales from November 1st to the date of the fire, also November 21st. Based on recent history, Hodge's gross profit ratio on product text is 35% of net sales. They want us to estimate or calculate the estimated loss on the inventory from the fire using the gross profit method. Okay, well, just like in the last problem, we'll start with beginning inventory, which was $100,000. We're going to add to that net purchases, which we would know from the records. We would have both of these numbers, beginning inventory and net purchases. This is assuming inventory was counted at the end of October. And we're going to make that assumption here. Net purchases were $140,000. When we add those two together, we get cost of goods available for sale. $240,000. You guys, these numbers are not estimates. We knew beginning inventory, we knew net purchases. We add those together, we get cost of goods available for sale. And now we're going to have to estimate cost of goods sold. So less cost of goods sold. We'll start there with net sales. We know what net sales were through the date of the fire, November 21st, $220,000. All right, now normally we'd say net sales minus cost of goods sold to get gross profit. Here we're working it in the opposite direction. Our estimated gross profit is 35%. I could say of net sales. So we'll say 220,000 times 0.35. That gets us 77,000 is our estimate of gross profit for those 3 weeks in November. We're now going to subtract, and we get estimated cost of goods sold, which is equal to 220,000 minus 77,000. This 143,000 is our estimate of cost of goods sold. Now we're going to subtract our estimate of cost of goods sold from cost of goods available for sale. And that gets us our estimated ending inventory. So our estimated ending inventory would be equal to cost of goods available for sale minus estimated cost of goods sold. So our estimated ending inventory was $97,000. But you guys, in this case, it was not a complete loss, right? We didn't lose everything in ending inventory. They say usable damaged goods can be sold for $12,000. So we're going to subtract that out. Less value of usable damaged goods, 12,000. Okay, and that difference we are estimated loss from the fire. Which is easy to see, it's going to be 85,000, right? That one's a little bit different. Any value of goods that we can still sell should not be part of our fire loss that we turn into the insurance. Just probably just another example of why a perpetual inventory system is better. Although if you didn't have those records backed up somewhere off property, fire could have destroyed those as well. But I think after working this one, you shouldn't have any problem with exercise 9.6 on the Connect Plus site. If you have any questions, please be in touch. Thanks.